Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 78. On today's episode, we're just going to talk about a lot of the market action that we've seen over the last couple of weeks. FTX, Elon Musk and Tesla, the Federal Reserve, and how that has impacted the Santa Claus rally, and how all these stories could potentially impact 2023 and what the market looks like. So let's just talk about all of these stories. Get your mind right. Let's get to work.
You dropped this.
So this week, we once again saw the Federal Reserve raise interest rates. They raised it 50 basis points, which brings the federal funds rate to around 4.4%. And I think it's interesting. So we're getting to the end of 2022, obviously, and I want to kind of let you know that last year we did that goals episode where I interviewed 4 different people, what their goals were for 2022. And I'm happy to report that we're actively recording the follow-up to that. So look for that probably next week, where we kind of we discuss how those goals went for them. But when I think about the federal funds rate being raised for now at 4.4%, when I was younger, I would buy like Money Magazine and Fortune Magazine, and I would look at all these experts, and I would look, see what their predictions were for the next year for different stocks. And I would always put those magazines in a drawer. And then at the end of the next year, I would look at them and see, okay, who was right, who was wrong, which of these worked out, which ones of them didn't. And pretty much most of them were about a 50-50 on most of those when I would go back and look at them again. And so predictions are not very, historically are not very good. And I think it's interesting because last year the Federal Reserve said that they predicted that they would raise rates one time this year. One time. And so far they've done 7. So we now have interest rates at the highest point from the previous then 15 years. So I think 2007 is the last time interest rates were this high. And so, you really can't go very, predictions are not that great. I mean, predictions historically are not that great. And so now you can bring in what's called projection bias, which is you take what you're seeing today, you project that into the future. And so last year, everybody projected that 2022 would be a good year 2022 would be a good year because 2021 and 2020 were a good year. So they project that into the future. Now everybody's projecting that 2023 is going to be bad. And, we'll see. I mean, we've had this bear market for a while now. NASDAQ is down 31% for the year. Has not been a good year for tech stocks. Worst year since 2008. S&P 500 is very close to down 20% for the year. And so we have a lot of negativity baked in. We'll see what ends up happening. But these rates, the higher they go, I'm not really sure what the Federal Reserve, what maybe investors were expecting them to say this past week. The market was actually up Monday and Tuesday in anticipation of these rates. Everybody expected the 50 basis point move, but it was really the words of Jerome Powell that really sent the market down into a tailspin. And so, I'm not really sure what people expect him to say. Yes, inflation's coming down. It hasn't come down that much. And so he has to be very careful with how he chooses his words on when, they think that rate hikes are going to not go up as much or when they're going to bring them back down. But his commentary is that, hey, we're going to raise these rates. We're probably going to end up somewhere around 5%, and then we're going to leave them there and see what it does to the economy and how the economy reacts. And so he's looking for employment to come down, rates that employers are paying people to come down. And I guess this is where I'm a little bit contrary. And I think that one of the stories that isn't being talked about enough is that every single day there's a lot of, there's baby boomers retiring every single day. It's the largest generation that we've seen in recent memory. And replacing those baby boomers is very, very difficult. And so the younger generation, it's kind of 18 to 20 right now, is a very large generation as well, but they're not in the workforce yet. And so, the baby boomers, when you see kind of throughout history, they've changed kind of the just the U.S. wherever they were at. They've changed the housing boom, just kind of wherever they were in their life stage. And so I think it's one of the stories that's not really talked about a lot, but I mean, it's really difficult to replace these baby boomers. So when you look at like airline pilots, for example, they have to retire at 65. Well, you look at, when you see stories about airline pilots, you'll notice that they talk about they're having trouble replacing, there's not enough airline pilots. And you're seeing that throughout almost every single industry. And so the Federal Reserve trying to raise interest rates to a point where people start getting laid off, and that I'm not sure that they're going to see the unemployment rate reach the level that they want to reach, simply for the fact that you have so many baby boomers that are retiring and leaving the workforce. And there's also, a number of different areas. There's not as many women in the workforce. There's just these little kind of pockets there, but it'll be interesting to see what happens with that. I think that you'll see inflation come down. People are starting to curb their spending. You had, when you look at the November number for retail sales, it dropped quite a bit. And so I don't know. I don't know if we're going to see the unemployment mark go up as much. Obviously, it's going up in tech. Tech companies are laying off a lot of people, and a lot of them need to. You heard me say this a couple weeks ago, but there are some tech companies that are definitely have way too many people on their payroll, and that's kind of what happens when you have a boom and companies get complacent. And I'm sure many of you listening to this, you work for a company. And if I asked you to make a list of 3 things that your company does to waste money, or ways that you would improve that business, you could probably come up with a couple different examples of, if you are running the business where you could save money, right? So almost every business out there has some things they could do to kind of tighten their belts, if you will, to make it a little bit more effective. And you in your personal life as well. I mean, there's things you can do. You can not eat out as much. You can not spend as much money on entertainment. I mean, there's certain things that you could do to save money for yourself or your household and be able to save or invest more. So, but normally this time of year we get what's called a Santa Claus rally. You get a pretty big bump in the stock market. People feeling good about holiday shopping, people spending money around the holidays. So I don't know, maybe the Federal Reserve just shot Santa out of the sky. We shall see. The last time the Federal Reserve was raising rates like this was 2018. And the bottom that year was on Christmas Eve, and that was a pretty bad month for stocks. So we'll see if that continues. When you look at the S&P oscillator, it's getting a bit oversold. So we should see some type of bounce. I mean, I'm not, I still am kind of surprised how much the markets moved down this week. I think it was kind of an overcorrection. I mean, I think that, there's always going to be companies making money somewhere. So you just kind of got to find it. And still, this is a great, this is a great lesson for all of us. And the fact that when you think about macroeconomics, interest rates, things like that, I mean, the companies that you invest in have zero control over that. And so if you're investing in good companies and you have the right time horizon in your mind, thinking about, I want to be invested in this company for years to come, these kind of interest rate situations, the market will adjust, companies will adjust. It takes a little while for that to happen, but good companies, figure out a way, good management teams figure out a way, they adapt to market conditions, and they will figure out a way to be profitable. You just kind of got to be patient in the meantime, which is can sometimes be quite painful when you're just sitting there watching it every single day. It is definitely not fun. So you pair that story, you look at a company having a lot of trouble right now, which is Tesla. Still, Tesla is one of the most popular retail stocks available that's out there. But when you look at what has happened to them since Elon Musk took over Twitter, they are down 30%. Tesla is down 30% since not since it was announced. I mean, like since the deal closed, since he actually took over Twitter, Tesla stock is down 30%. And so part of that is him selling it. Like he sells the stock. This past week, Tesla had a really bad week, and then it came out that Elon Musk sold another $3.5 billion. The problem with that is in the beginning, he said that he wasn't going to sell any more stock, and then he continues to sell it, which makes some of the other investors mad. Over the past couple years, there have been a lot of hedge funds, maybe hedge funds, big retail investors that have bet against the stock, meaning they shorted Tesla stock, and they've lost money for years. I mean, shorting Tesla has been a really easy way to lose money over the years. And now it seems like they've kind of come out of the woodworks to like short the stock during their time, during this transition time. And so it's interesting to watch that play out. So when you look at Tesla is currently trading at $150 a share. Now, obviously, this isn't the lowest price that Tesla has ever traded at, but it is the lowest valuation that Tesla has ever traded at. So when you look at Tesla's PE ratio, price over earnings, let me see where it is right now on Yahoo Finance. I think it's around, forward earnings for Tesla. When you look at where what their earnings are supposed to be next year, it's trading at a forward PE ratio of around 30, which is easily the lowest valuation that it's ever been. But this is the risk of owning Tesla's shares, is because Elon is so connected to the stock that what he's doing, what's going on in his other world, these other companies, really starts to bleed over. So this is kind of a hard one. I mean, when you look at historically, betting against Elon has not worked out well. But it is hard to look at Tesla when it's dropping every single day and say, I'm going to pick up, I'm going to go in and buy some shares of that when it's down. I mean, this past week, you just look over the last 5 days. Last Monday, it was $173, and now it's $150 in a week, and none of those days were up. So you kind of got to let this thing steady out before you look at maybe buying some shares of that. But that is just going to be a continuation with that story and seeing how that evolves. But maybe if some good news came out on Tesla deliveries, or how many cars they're selling, that could definitely help the stock. The other thing I thought was interesting this past week was when you look at FTX and you look at Sam Bankman-Fried getting arrested. He's now been arrested. He's in a Jamaican jail, and they did some congressional hearings this past week. And you see the interim CEO discuss looking at FTX, and they were asking him if he thought it was an elaborate scheme that FTX was pulling off, and he basically said, "This is just old-fashioned embezzlement. This is just old-fashioned somebody stealing your money, moving it somewhere else. It wasn't an elaborate scheme." He said it was maybe elaborate in the way that they were marketing, getting high quality spokespeople for the company, but it doesn't seem. This is to me. This is more of a kind of following the crowd, type situation where there was a lot of big hedge funds in there. It doesn't seem like anybody did due diligence. They just said, "Oh, this person is in it. They must have done due diligence, and since they probably did due diligence, I don't need to do my homework." And so, very much a cautionary tale of following the crowd for a lot of these big investors. And so you see Kevin O'Leary, who is Mr. Wonderful on Shark Tank. He was taken for, and he really wasn't taken like this is, he was paid $15 million to be the spokesperson. He put that money in and he lost that. So he didn't really have his own kind of personal money, kind of how we would think of it, but it's still quite painful. It's probably more painful for him just on a reputation basis to have an investment go bad that's so public, to be so, to have something that is kind of so spectacularly covered. I would think would be probably the more hard part for him just for what he does. But it's definitely just, I think about, I think I've said this already, but the tech bubble bursting in 2000, and you had Enron go down, and then you had Bernie Madoff in 2008, and then now you have FTX in 2022. Like, I truly believe there's always a company out there doing something they shouldn't be doing. There's always somebody who hasn't been caught yet. There's somebody that, it's just the way that it works, right? I mean, there's somebody out there doing something that they shouldn't be. And when you get these big market corrections, I mean, it's kind of what Warren Buffett says, right? You don't know who's swimming naked till the tide goes out. And so it's just one of those, when you have these big market corrections, these companies that are basically faking everything, they just cannot hold it up anymore because they can't keep faking the numbers because it just doesn't make any sense. And it'll be interesting to see what kind of regulations come into the crypto space. All these companies are having massive withdrawals. And it's going to take that industry a while to recover. And of course, you'll see they'll compare it to tech companies in the early 2000s. And so there will be companies that do recover. There will be some of these companies that have dropped 90%, and in 5 years from now, 7 years from now, we'll say, man, why didn't I invest in those companies? So even though it's painful, you really have to look at some of these companies that have been beat up and start thinking, when you have the NASDAQ down 31%, which of these companies that are out there are the ones that you should be investing in, that you should at least be doing some research on and thinking about, okay, who's going to make it through this storm, and who would I be comfortable investing money in? And so I know I don't, give specific names. I try not to. I'm not your financial advisor. That whole thing for entertainment purposes only. But go look at some companies that have been beat up, and just think about what are the risks of that for that company in the future. And also, I mean, some of these companies, it's really not that complicated. Like Amazon is trading at $87 a share. It was 183, and I know so that's anchoring. That's an anchoring bias. I'm using that 183 as kind of an anchor and saying, oh, the stock's cheap. That could not be true. But, you go in, you look at Amazon, you look at the parts of that company, you start trying to evaluate those. But at some point, you have to start thinking, okay, what's going on here? So one of the other things I just want to quickly mention is that at the end of the year, some of these companies that have been down a lot are going to fall a little bit more because investors will sell those companies to take the tax loss. Right. So we call that tax loss harvesting, where you're trying to balance out gains and losses for your taxes. This year you can take $3,000 worth of loss. But let's say you had a gain somewhere, you sell $10,000 worth of gain. Now you're going to be looking for $10,000 worth of loss somewhere so that you can balance those out, so you're not paying taxes on the gain when you have losses in your investment portfolio. Well, when you do that, you can't buy that stock back for 30 days or it negates the loss. That's the wash sell rule. I did an entire episode on the wash sell rule, so you can go look that up. But if you take a loss on, let's say, Amazon today, you're not going to be able to buy it back for 30 days. And so that's why sometimes you'll see some of these stocks drop in December, and then mid-December they fall, and then all of a sudden mid-January they get this big spike up. Well, it's because the institutions are buying those companies back. It's not that they don't want to be invested in those companies, but they sell out a little bit to be able to take the tax loss, and then all of a sudden they're going to buy them right back. So that does happen, and especially in a year like this year where people have gotten beat up on a lot of companies, you're going to see it a little bit more. So make sure you kind of think about that. And so I don't take some of these losses at the end of the year. Some of these companies might be a little bit further down than they should be, simply for that fact that people are taking those losses, and it's especially true if it's a company that's very popular. Right, a company that a lot of people own, you'll probably see that a little bit more. So, don't read too much into the things that you see at the end of the year. It's been a bad year, but we have hope for the future. And so, there's a lot of cross currents going on in the market right now. So because of that, the companies that you invest in, and yes, you should invest even during bad times, and the companies that you are looking to own, instead of making big purchases, just say, I'm going to put a little bit in every single month. Every single time I get paid, I'm going to buy a little bit more of these companies, and you'll be able to ride out the storm, and there will be better days ahead. So I hope this is helpful for you. We'll talk more about how to plan for 2023 in future episodes. But again, hope this was helpful for you. Can't wait to talk to you again. Have a great week. I'll see you next time. Thanks, everybody.